Today, nearly every country in the world is in debt. The United States owes more than $38 trillion. The European Union carries around $14 trillion in debt, while Japan's debt is close to $9 trillion. Even wealthy oil producers like Saudi Arabia and major export economies such as Germany and China borrow heavily. This raises a simple but important question. If everyone is in debt, who is the creditor? At first, the answer seems complicated, but debt is one of the foundations of the modern financial system. It is not only money that must be repaid, it is also a tool used to finance governments, businesses, wars, infrastructure, economic growth, and responses to financial crises. Global debt has risen above $315 trillion, roughly 3 times the size of the world economy. Yet much of this debt circulates within the same global system. To understand how this happened, we need to go back several centuries. Modern government borrowing did not begin on Wall Street. Its origins are closely connected to war. In 1694, England was struggling to finance its war against France. The royal treasury was running low, so the government borrowed money from wealthy merchants. In return, those merchants received regular interest payments funded by future tax revenues. The Bank of England was created to support this arrangement. This was a revolutionary idea. The government could spend future income before collecting it, while lenders received documents proving the government's promise to repay. These documents could also be traded between investors. That system eventually developed into the modern government bond market. France later adopted similar methods. The Netherlands improved them. The United States used government borrowing to finance its war of independence and westward expansion. Over time, the ability to borrow became a sign of confidence rather than weakness. If investors were willing to lend to a country at low interest rates, it meant they trusted that country's economy, institutions, and ability to repay. Today, borrowing keeps much of the global economy moving. Governments issue bonds, banks create loans, investors buy and sell debt. Citizens participate through taxes, savings, mortgages, and retirement funds. So who actually owns government debt? Consider the United States. A large share of U.S. debt is held by American banks, pension funds, investment funds, insurance companies, and the Federal Reserve. Foreign governments and international investors own another portion. Japan holds around $1 trillion in U.S. Treasury securities. China holds roughly $800 billion. The United Kingdom, Luxembourg, and Belgium also hold significant amounts. So the statement, America owes money to China, is partly true, but it explains only a small part of the picture. Most U.S. debt is still held within the United States. The system works like this. The U.S. Treasury issues bonds to raise money. Banks, funds, governments, and investors buy those bonds. The Federal Reserve may also purchase them, adding money to the financial system. Tax revenue is then used to pay interest to bondholders. That interest flows into banks, pension funds, investment accounts, and other institutions. In other words, money moves through different parts of the same system. The debt is real. The interest cost is real. But the borrower and the creditor are often different parts of the same economy. The same pattern exists globally. Japan buys American bonds. The United States provides financing to other countries through international institutions. European countries lend to developing economies. Developing economies then invest their foreign exchange reserves in American or European bonds. A country can therefore borrow from the global system through one channel and lend back into it through another. It is a vast network of interconnected obligations, and the entire system depends on confidence. As long as investors believe that governments will continue paying interest and refinancing maturing debt, the system keeps functioning. Financial markets play a central role in the debt system. Pension funds, banks, hedge funds, sovereign wealth funds, investment funds, and central banks manage enormous amounts of money. Their decisions influence how easily a country can borrow and how much interest it must pay. When confidence is strong, borrowing becomes easier and cheaper. When confidence weakens, interest rates rise, currencies lose value, and economies come under pressure. Central banks also support the system. Their role is not limited to setting interest rates or creating money. They can purchase government bonds and inject liquidity into financial markets. One institution's debt becomes another institution's asset. That is why the modern monetary system and the debt system are deeply connected. Much of the money circulating in the economy is created through loans and debt. But what happens when confidence disappears? History gives us several warnings. In 2010, Greece's debt crisis caused investors to panic. Interest rates rose sharply, and the European Central Bank and the International Monetary Fund stepped in. The rescue packages came with strict conditions. Taxes increased, public spending was reduced, and unemployment rose. For many Greek citizens, the bailout did not bring relief. It brought harsher living conditions. Argentina has experienced repeated defaults, turning debt into a long-term economic problem. Sri Lanka faced a similar crisis when its foreign exchange reserves were nearly exhausted. The government struggled to repay foreign debt. Fuel shortages, mass protests, and political instability followed. When the system operates normally, creditors remain largely invisible. During a crisis, however, bondholders, credit rating agencies, central banks, and the IMF suddenly move to the center of attention. Once the crisis passes, the system usually starts again. Old debts are restructured, new loans are obtained, new bonds are issued. The debt does not disappear, it continues under different conditions. An individual who borrows from a bank is expected to repay both the principal and the interest. Governments operate differently. When government bonds reach maturity, a country can issue new bonds to repay the old ones. This is called debt refinancing. The old debt is paid, but new debt takes its place. For this reason, large economies rarely plan to eliminate all public debt. Their objective is to keep it affordable, sustainable, and under control. No one expects the United States to repay its entire debt at once. Japan has also refinanced its debt for decades, even though its public debt is more than 2.5 times the size of its economy. Investors continue buying Japanese bonds because they do not expect the debt to disappear. They expect the government to continue making payments without disruption. Government bonds are not only liabilities, they are also valuable financial assets. Banks use them as collateral. Pension funds hold them as investments. Central banks keep them as reserves. One country's debt is another investor's asset. If the United States suddenly repaid all of its debt, banks and investment funds would lose one of the world's most important safe assets. The amount of dollars circulating in financial markets could also decline sharply, potentially causing deflation and financial instability. The most important issue is therefore not simply how large the debt is. Can the government pay the interest? Is the economy growing? Do investors still trust the country? Is the debt issued in the country's own currency or in a foreign currency? These are the questions that truly matter. The real danger begins when new borrowing is no longer enough to cover existing debts and interest payments. At that point, the cost reaches ordinary people through higher taxes, unemployment, inflation, and cuts in public services. Debt can also increase inequality. Taxes are collected from broad sections of society, while interest payments flow mainly to banks, funds, companies, and investors that own the bonds. However, creditors are not always villains, and borrowers are not always victims. Without credit, companies could not invest. People would struggle to buy homes and vehicles. Governments would find it difficult to finance infrastructure, healthcare, and other essential services. The real problem is not the existence of debt. The real question is whether debt is being used productively and whether it can remain sustainable. Governments, banks, central banks, companies, funds, investors, and citizens are all connected within the same system. The boundary between borrower and creditor is not always clear. A person may owe money on a mortgage while also owning government bonds indirectly through a retirement fund. Modern debt is therefore more than a burden. It is also one of the mechanisms that keeps the economic system moving. But the system can survive only as long as confidence remains. Because when confidence disappears, all that remains are promises that still need to be fulfilled. And in the end, that is what debt truly is. A promise that people believe will be honored in the future.